Hello everybody and welcome to this short video explaining financial statements, the profit and loss, the balance sheet and the cash flow. If you're like most business owners that I meet, you may struggle a little bit with the financial statements. I've been working as an accountant for many years now. I was 13 years in multinationals as a financial controller in manufacturing plants. And since then, I've spent nearly 20 years working with owner managers and trying to help them understand and manage their finances. And the one thing that has common is that a lot of them feel a little bit intimidated by the financial statements and by the jargon that we accountants can sometimes use around it. Over the years, I've put together a training workshop called Finance for Non-Financial Managers. And to help the clients or to help the participants understand financial statements, I developed a simple little case study. And I'm going to take you through that case study now. So let's start off with scenario A. And Anthony has 1,500 euros in the bank. And Anthony has a great idea. He's going to buy 1,000 cans of Coke for €1 each for cash. He'll then go to a football match. They're going to charge him 50 euros to get into the ground. And they're going to charge him another 100 euros to hire one of their stalls, their vendor stalls. So Anthony does that, he pays them the money, and then he sells his cans at the match. He sells 600 cans of Coke at €2 each. Now, at this point, I'm going to stop. You can pause the video and just calculate for yourself how much profit did Anthony make. Okay, now you've calculated your profit. A lot of people in the classes would tell me that Anthony made about 50 euros profit. And the way they work that is that they see that he sold the cans for €2 each. So 600 cans for €2 each is 1,200 euros. He spent 1,000 euros on the Coke, so that leaves him with 200. And then he spent 50 and 100 on the permit and the stall, so that left him with 50. And that's probably the most common answer I get. And as you probably expect, it's also the wrong answer. The thing to remember here is that Anthony sold 600 cans, so he still has 400 left. So when I'm, from an accounting point of view, when I'm looking at the profit, he sold 600 cans, so he made the 1,200. But he only used up 600 cans at €1 each, so that left him with 600 euros. And then he paid for the permit and the stall another 150, so that brings him down to 450. So the accountant looks at that and says he has 450. Now, let's look at the financial statements. We start off with the balance sheet. And the balance sheet, the thing to remember about the balance sheet is that it lists what you have and what you owe. Now, the accountants will call that your assets and liabilities. But if we start off, at the very beginning, Anthony has no stocks, he has no customer balances, debtor balances, and he has 1,500 in the bank. So the total assets, or the total amount that Anthony has, is 1,500. Now, from the point of view of a business, Anthony has given that money to the business, so the business owes that money back to Anthony. So we put in the capital account of money owing, and the business owes Anthony that money back. He effectively loans that money to the business. So our opening balance sheet has 1,500 in assets, which is the bank, and then the 1,500 owed back to Anthony. So we're looking at it from the business perspective. Next, we look at the profit and loss, and the profit and loss looks at the trading. Now, the order I have these in are not the way you normally find them, but they're done for a reason. So if I go up here and look at, I've got sales of 1,200, but I've got cost of sales of 600. And the cost of sales is his opening stock of nil, his purchases of 1,000, which is up 1,000, and then he's got 400 left, so you take that away to leave you with the 600. So you've got cost of sales of 600 and his expenses of 150. So Anthony has a profit of 450. Now we look at what happened with cash. He sold, so he collected 1,200 euros. We assume that everybody paid him. Before that, he paid out the suppliers of 1,000 and he paid out the 150. So Anthony's cash is up 50. And now we look at our closing balance. Anthony now has stocks. He's got 400 cans of Coke left over and they cost him €1 each. So Anthony has 400 in stock. Everybody paid him, so he's owed nothing. His customers don't owe him anything. And he's got 1,550 in the bank. He started with 1,500 and we had the movement, so he's up 50, so he's got 1,550 in the bank. Now we look at what the business owes. Anthony loaned 1,500 at the start, so that 1,500 is owed back to Anthony. Plus, the business made a profit of 450. Now, the question there is, whose profit is that? And it's Anthony's business, so the business effectively owes that money back to Anthony. So we treat profits as an amount owing to the owners, and we put them in on the side of the amounts that are owed. And we call it equity because it's Anthony's stake in the business. He shared in the business. So we've got 1,950 equity. The initial 1,500 he put in and the 450. So just look at the big picture here. Starting balance sheet was 1,500. We'd say the net assets were 1,500. Net assets being assets less any external liabilities. And we started there and we wound up going up by 450. The increase is explained by the profit and loss. The increase of 450 belongs to Anthony. It's added on to his capital account, so the business owes Anthony 1,950 back. And that 1,950 is held as assets. Anthony is 400 in stock and he has 1,550 in the bank. So the business now has assets worth 1,950 and those assets are owed back to Anthony. The 1,500 loan he gave, which is still in there in the bank, and then the 450 profits he made, which is between the stocks and the extra bit of money in the bank. So your profit and loss explains the movement between your two balance sheets. Your cash flow is the movement of a cash. Cash is part of the balance sheet, but you can have a profit of 450 and only have 50 in cash. Cash and profit are not equal, and that's a very important distinction. I just have one image I want to show you, a very rough image. But when I was young, I used to watch cartoons and we had the Roadrunner. The Roadrunner would speed along the road. If there was a milestone here that said maybe 5 kilometers, and then further on up the road, there was another milestone that said 10 kilometers. Well, we could figure out in our heads that Roadrunner had done 5 kilometers in the distance. However, what happens if the second milestone was actually put in the wrong place by mistake, if the county council workers got it wrong? Well, then you're going to calculate the wrong mileage, aren't you? Well, if we go back to scenario A, the first milestone is our balance sheet. And remember this, a balance sheet is always at a point in time. It's always at a fixed date. And then we have the last balance sheet at another point in time. It could be out a month, a year, a quarter, whatever, but it's out a distance. The profit and loss is always for a period in time. The profit and loss summarizes what happened over a period of time. So the opening balance sheet is like our first milestone, and the closing balance sheet is like our second milestone. And the profit and loss explains the distance between the two milestones. If we get our balance sheet wrong, our profit and loss is going to have to be wrong. So it's very important that we understand this and we get it right. And again, if we assume there was no cans of Coke left at the end of the period, if we assume the 400 was gone, then we would have said that he only made 50 profit. But that would be getting our milestone wrong. That would be that would be making a mistake. So they're the key points there. Understanding the balance sheets are at a point in time and that they measure what the business has and what it owes. The P&L then explains to you what changes have occurred between any two balance sheets. And the cash flow statement just focuses on cash. Cash is part of the balance sheet, but it's not the whole lot of the balance sheet. However, cash is very important because a business can't survive very long without cash. So I'm going to pause at this stage and I'll move on with the second part of this video series and we'll look at scenario B.